Hey, this is 1001 Investing Channel. We are here with tips and secrets about investing. So please pay attention to this audio. The word extremely in the title is a kind of pun, because the histories represent extremes of various sorts that were manifest on Wall Street in recent years. They hold instruction and grave warnings for everyone who has a serious connection with the world of stocks and bonds, not only for ordinary investors and speculators but for professionals, security analysts, fund managers, trust account administrators, and even for bankers who lend money to corporations. The 4 companies to be reviewed, and the different extremes that they illustrate are: Penn Central Railroad Company. An extreme example of the neglect of the most elementary warning signals of financial weakness, by all those who had bonds or shares of this system under their supervision. A crazily high market price for the stock of a tottering giant. Ling Temco Vought Incorporated. An extreme example of quick and unsound empire building, with ultimate collapse practically guaranteed, but helped by indiscriminate bank lending. NVF Corporation. An extreme example of one corporate acquisition, in which a small company absorbed another 7 times its size, incurring a huge debt and employing some startling accounting devices. AAA Enterprises. An extreme example of public stock financing of a small company, its value based on the magic word franchising, and little else, sponsored by important stock exchange houses. Bankruptcy followed within 2 years of the stock sale and the doubling of the initial inflated price in the heedless stock market. The Penn Central case. This is the country's largest railroad in assets and gross revenues. Its bankruptcy in 1970 shocked the financial world. It has defaulted on most of its bond issues, and has been in danger of abandoning its operations entirely. Its security issues fell drastically in price, the common stock collapsing from a high level of 8612 as recently as 1968 to a low of 512 in 1970. There seems little doubt that these shares will be wiped out in reorganization. Our basic point is that the application of the simplest rules of security analysis and the simplest standards of sound investment would have revealed the fundamental weakness of the Penn Central system long before its bankruptcy, certainly in 1968, when the shares were selling at their post-1929 record, and when most of its bond issues could have been exchanged at even prices for well-secured public utility obligations with the same coupon rates. The following comments are in order. 1. In the S&P bond guide, the interest charges of the system are shown to have been earned 1.91 times in 1967 and 1.98 times in 1968. The minimum coverage prescribed for railroad bonds in our textbook security analysis is 5 times before income taxes and 2.9 times after income taxes at regular rates. As far as we know, the validity of these standards has never been questioned by any investment authority. On the basis of our requirements for earnings after taxes, the Penn Central fell short of the requirements for safety. But our after-tax requirement is based on a before-tax ratio of 5 times, with regular income tax deducted after the bond interest. In the case of Penn Central, it had been paying no income taxes to speak of for the past 11 years. Hence the coverage of its interest charges before taxes was less than 2 times, a totally inadequate figure against our conservative requirement of 5 times. 2. The fact that the company paid no income taxes over so long a period should have raised serious questions about the validity of its reported earnings. 3. The bonds of the Penn Central system could have been exchanged in 1968 and 1969, at no sacrifice of price or income, for far better secured issues. For example, in 1969, Pennsylvania RR 412S, due 1994, part of Penn Central had a range of 61 to 7412, while Pennsylvania Electric Company 438S, due 1994, had a range of 6414 to 7214. The public utility had earned its interest 4.20 times before taxes in 1968 against only 1.98 times for the Penn Central system. During 1969, the latter's comparative showing grew steadily worse. An exchange of this sort was clearly called for, and it would have been a lifesaver for a Penn Central bondholder. At the end of 1970, the Railroad 414s were in default, and selling at only 1812, while the utility's 438s closed at 6612. 4. Penn Central reported earnings of $3.80 per share in 1968. Its high price of $8.612 in that year was 24 times such earnings. But any analyst worth his salt would have wondered how real were earnings of this sort reported without the necessity of paying any income taxes thereon. 5. For 1966, the newly merged company Asterisk had reported earnings of $6.80 a share, in reflection of which the common stock later rose to its peak of $8.612. This was a valuation of over $2 billion for the equity. How many of these buyers knew at the time that the so lovely earnings were before a special charge of $275 million or $12 per share to be taken in 1971 for costs and losses incurred on the merger? O wondrous fairyland of Wall Street, where a company can announce profits of $6.80 per share in one place and special costs and losses of $12 in another, and shareholders and speculators rub their hands with glee. 6. A railroad analyst would have long since known that the operating picture of the Penn Central was very bad in comparison with the more profitable roads. For example, its transportation ratio was 47.5% in 1968 against 35.2% for its neighbor, Norfolk and Western. 7. Along the way there were some strange transactions with peculiar accounting results. 1. Details are too complicated to go into here. Conclusion: whether better management could have saved the Penn Central bankruptcy may be arguable. But there is no doubt whatever that no bonds and no shares of the Penn Central system should have remained after 1968 at the latest in any securities account watched over by competent security analysts, fund managers, trust officers, or investment counsel. Moral: security analysts should do their elementary jobs before they study stock market movements, gaze into crystal balls, make elaborate mathematical calculations, or go on all expense-paid field trips.
Thanks for watching. I will upload a video every day with tips and solutions. So, for more, please like it and subscribe. It's free. Bye-bye.